My name is Chris Tobe, and I have been in the investment business for well over 30 years now. I spent my first 10 years in bank trust departments, and then was hired by the Kentucky State Auditor specifically to review the retirement systems in Kentucky. One was a $12 billion state retirement system, and then the $14 billion teachers retirement system was my main project. We also looked at some of the endowments from the public universities, and some public cash management as well in my 3-year tenure with the Kentucky State Auditor in the late 90s. Back then, there were very few people working on issues around fees in public pension plans. And the one person I found down in Florida was a guy named Ted Sedell. And Ted had done some, as an former SEC attorney who had started his own consulting firm and was starting to look into some of the abuses in public pensions. So Ted and I have been working together on and off projects here and there for the last 20 years, and that's how we got started. After that, I went to a consulting firm for a while called Fund Evaluation Group, which is mostly endowments and foundations. Then went working for a large insurance company on investments, 401k investments, Aegon Transamerica. Then got back to consulting with New England Pension Consulting Group in the late 2008, 2009. Then kind of went into my own consulting business after that, and also at the same time was named a trustee for the $12 billion Kentucky retirement systems. So got involved as a consultant and as a trustee in the period of 2008, 2012, where I was a trustee. And then after that experience, I became an SEC whistleblower on the Kentucky Public Pension Plan, and Ted Sedell was my whistleblower attorney. The SEC eventually did not do anything, but it led to my book, Kentucky Fried Pensions, that you have looked at, and encourage everybody to look at that on Amazon for a very long, detailed explanation of the Kentucky pension crisis. And I've been involved in Kentucky ever since. Since then, I've worked with another consulting group, the Hackett Group, or I've done for the University of Maryland, looked at their investments there. The legislative auditor of Utah hired me to look at their hedge funds. Then I've helped Ted Sedell out in North Carolina, Rhode Island, and some of his projects. And then Ted had become very involved lately with Ohio, and I helped him a little with that, and went up to Columbus a month ago. But then Chicago, someone talked to me about Chicago, and he just told me, he didn't have the time. He just handed off the Chicago one to me, and I did that one by myself, even though I talked with Ted quite a bit on that as well. From the legal side, I'm more of an investment person, where Ted's a little more on the legal side. And I looked at some of his reports, his latest Ohio reports, mostly for the way to structure it legally, because these reports are structured in a lot of ways for future litigation. We like to see media, we like to see some movement, and this report did result in the new trustee being elected. But some of it, may eventually end up in the courts, and that's why a lot of these reports I write have those the elements in it around fiduciary duty and around the legal issues that we address in public pensions.
Okay, so then you got in contact with the Chicago Police Accountability Group. Why don't you talk a little about that and walk through your process of what you discovered and your thoughts as you were discovering different items?
So Rose Giambecca, the lady who was in charge of the group, and Wayne Metcalf is another leader, we talked about these things. They had a lot of just general mistrust of the management there, and different issues on disability payments and different type of payments as well. And as I explained to them, that really wasn't my area of expertise, but I knew where there were problems in Chicago, and I could outline those in detail. I covered some of the other issues as well, in more of a broader sense, but in detail, I could really get into the investment issues and some of the funding issues with the Chicago Police in a report form that would help them start this process of reforming the plan. So as we talked, we it's got the report, in the report called Twisted Priorities. We got into a lot of the areas they had originally looked at, that, like overpaying for their rent and things like that. But those really paled in comparisons to the overpayment of fees with the private equity real estate partnerships, and then the lack of transparency was this rampant, and still the Chicago Police Fund refused. All of my data came from the website, and all my requests for for more detailed contracts, which should be public to everyone, were all denied, and we are still in court over those issues. And I don't know, do not know how that's going to be resolved.
One of the findings in your report was there's potentially $70 million in largely unaccounted fees on a $300 million investable pension fund. That seems like a pretty high asset to fee ratio. What were some of the other red flags you discovered?
One of the red flags is that on different reports, I'd find different managers, and I call them ghost managers in the report. So on the custodial report, there'd be like 40 different managers. A lot of these are still private equity partnerships, some that are very old. And then I would find on the consultant reports, maybe 30 managers. And then on the actual financials, I would find 20 managers. So they were reporting the results on just a fraction of the managers, and not even listing their names. So that was a big red flag on transparency, when you've got, 3 sets of books here almost of different managers going on with the same plan. So it's even hard to tell if my 70 million estimates are even in the ballpark. I think they're at least that amount, because the information here is so bad, transparency so low, that it's very difficult to get real hard numbers here. But I can show you the total lack of control shows that there are major fees left on the table, just because they didn't even acknowledge the existence of managers that are charging fees.
Any other red flags you discovered that are noteworthy of mention? Because those are two, you've already uncovered some pretty big ones.
Oh yeah, and I mean, there's just so many. It's just where to start on the red flags. You have, you decide, the chair of the board, an acting police officer, decides that they don't need a chief investment officer, that he is going to do the investing.
The first known case of this in the public domain, to my knowledge.
Yeah, the first note. Well, it is actually not the first. This same plan had a guy who did it for a few months, an active guy. This guy's been doing it for 2.5 years.
Okay, so this is an active Chicago police officer who is operating as chief investment officer. No CFA credentials, no previous experience in financial management.
No,
okay,
none whatsoever. So that was a red flag. Now, this particular officer was defeated in the election based on this report. And I think that even the police that were the FOP and the ones that are more traditional thought this guy had gotten a little out of line here in the report, Mr. Banya. And so he was defeated in the election, although the other reform candidate in the retired did not win the election. This guy, I guess, was so blatant that he did not belong in that position, that I think even a lot of the more traditional cops who were, FOP, even though he was officially endorsed by the FOP, a lot of their members, I think, bucked him because they saw kind of an overreach or some issues there with that, with trying to hold down that position.
Dwayne Metcalf has a fantastic story to tell. Just real briefly, kid grew up on the west and south sides of Chicago, impoverished neighborhoods, impoverished background, struggled through it, ultimately gets a master's in finance and financial fraud from St. Xavier University. And the FOP doesn't even interview him for the position on the pension fund board. And then he wins election. So there's some powerful change, and I'm going to make the argument that both Chris and more specifically the work Ted Seidel's been doing and some of the work out in Pennsylvania has been just outstanding. Yeah. So I think everyone's going to be looking forward to see what happens with Wayne. Are there any other details you'd like to discuss in the Chicago case before we move on to some of the more national news on this?
Again, Chicago has the problem. We have the big problem of them being underfunded, one of the worst funded plans in the United States. So the Chicago plan is unique in that there is real risk of police officers losing a part of their pension. States, because of our Constitution, cannot go bankrupt, but cities can. And Detroit went through a bankruptcy with fairly fully funded pensions, police and fire at 100%. And so even their general, they had one funded at 70%. They lost a little. The participants had to take like a 5% haircut on their pensions. The haircut on the Chicago, if it was to go into bankruptcy, would be the most significant in history. So they had the particular, not only the bad investments, but the funding level, the bad funding from the city of Chicago has left them in the riskiest position of any plan. Well, them and their sister plans, Chicago Fire, of any plans in the United States. For most other plans, remember, taxpayers pay for this, over excessive fees and mismanagement usually first, and the participants get in afterwards, or when things get really when you're getting toward the end. But always this is damaging taxpayers, and that's the thing people need to remember. This isn't just about participants. This mismanagement is really about taxpayers in the ongoing funding, nationwide.
Okay, why don't we move into some of the national ramifications here? Because I think what you're uncovering in Chicago mirrors to certain degrees what's being uncovered in Philadelphia, what Ted's previous work that you outlined in your book, and so let's start to pull it back. And why don't you tell a little about situations in Pennsylvania and Ohio? Just give the viewership here an overview of that situation.
I actually want to go back a little bit further. I mean, in the last, up until 20 years ago, public pensions invested mostly in stocks and bonds and a little bit of real estate. And all these investments were transparent. They held the custodian held the investments for them. They could see the investments, they could see the fees, they could see the commissions. Everything was and then when they selected managers, they would go through a competitive bidding process, an RFP process, which would be they would compare managers to each other, what their performance records in a fully transparent manner.
What year is that?
Probably 20 years ago, we started seeing, but it was a gradual evolution away from that. First, you had more real estate in the alternative. When we talk about alternative managers, these are not stock and bond managers. These are real estate, hedge funds, and private equity, the three main categories. And as we started to move toward those gradually, maybe 20 years ago was when the movement started, maybe 25 years ago, but it's just been gradual. But up to around 10 years ago, it really exploded, where they started, states would just forget or ignore their competitive bidding rules and would just do secret no bid contracts with all of these private equity and hedge funds. And this coincided with the Supreme Court decision, Citizens United, which allowed almost unlimited donations from Wall Street into super PACs for state officials and city officials. And
okay, now let's benchmark that year. What year are you talking about there? Citizens United comes into play, because it's relatively recent.
I think it's 8 or 9. Yeah, I got to see. We'll have to look at it.
I think you're right about 8 or 9.
I think it's 8 or 9 years ago is when it kicked in, and that's when I think the secret no bid contracts accelerated a lot in public pensions or around the country. Date decided 2010, so we are going on 11 years here.
Okay, so just so we can, and I can provide multiple sides to this argument. At this time in the pension fund industry, there was a movement for real diversification, and there are assets primarily managed with derivatives that are designed to be non-correlated to the performance of the stock market. So right. there are some legitimate uses for diversification, but I think kind of what ultimately spun out of this is just like a monster out of control, is my initial take on it. So why don't you keep going? I'm sorry, I interrupted you.
Well, again, I work for major consulting firms fund valuation group, New England Pension Consultants, and I was, part of that whole diversity argument. I did that to firm, as a consultant. So you kind of, I believed it to a point, but it doesn't mean that the secrecy and non-transparency and of performance and excessive fees is acceptable.
Yeah,
diversity is okay. There's nothing inherently wrong with private equity, real estate, or even a hedge fund. It's just the excessive secret fees and expenses that are wrong. And so you need to separate those. And again, the industry has been able to fight all this. We've had the CFA Institute has had performance standards, but the industry, the alternative industry, just refuses to acknowledge them because they want to cheat, in my opinion. I mean, they don't want to give transparency on fees and performance. And the public pension plans have just rolled over and let them do that and have ignored their fiduciary duties. And I think the reason they have rolled over is because politicians have told them, "Oh, go ahead and we don't, look the other way at this stuff. These people are our friends." And since Citizens United, especially now 11 years ago, that this has really accelerated across the country.
Okay, so fast forward to Pennsylvania and Ohio, and what's Ted discovering, and what's a columnist at the Philadelphia Inquirer who's doing some great work. What's being uncovered there as well?
Well, Pennsylvania, a lot of it was the work of the former treasurer, Joe Torricella, hired a Oxford private equity specialist, Ludo Filippo, about 4 years ago, I think. And he showed that there were over 600 at 6% fees in the private equity partnerships in the Pennsylvania plan. And what's different about Pennsylvania is that a mainstream reporter, Joe DiStefano at the Philadelphia Inquirer, covered that from the beginning extensively and throughout. And because of that continual continuous, what I call media presence in a major newspaper, and the Philadelphia Inquirer also picked up, those stories are picked up by the Pittsburgh papers and across the state, that has created this environment where the SEC and FBI have felt the need to step in. And so that is a very different environment. There's a dynamic there between this is the Pennsylvania teachers retirement. You have a dynamic between the two teachers union, the NEA, which has tended to back these alternative investments, and the AFT, which has not, and that plays out more in Ohio as well. But that Pennsylvania dynamic, but it was the constant mainstream media, which is unique in this country. We don't see that anywhere, New York, California, anywhere, what the Philadelphia Inquirer has done, which has really, I think, pushed it to this point where the FBI and SEC have felt they've had the cover to go in and look into the situation right now. Ohio is more, this is, Ted Siddell has more been the leader in the investigation side of Ohio teachers. And again, we have a dynamic not only between the NEA, but you have it between the Ohio AFT and the Ohio retired teachers are joining with the AFT kind of against the NEA in Ohio, as far as the dynamics on the pension there. And you'll find that, we found that in Rhode Island when Ted did work there, that it was the retired teachers who were concerned with these investments. The current teachers were so involved in the internal politics that have to do with the budgeting of education. Because remember, the NEA, they're more concerned about the governor's budget next year for that particular schools for ongoing, not on the retirement side. That they have a little different focus in the dynamics there going on inside there. So in Ohio, the differences between Ohio and Pennsylvania, Ohio has about 50 they pay huge salaries in Ohio. Several people make over $500,000 a year. They have
several people on the pension fund board.
Pension fund staff.
Pension fund staff, okay.
Yeah. On the Ohio pension fund staff. Now, Pennsylvania is fairly high paid, but Ohio has more than, I think, even California plans. They have a huge 30 or 40 staff members making over 300,000 a year. Several making over 500,000 a year, and a lot of those are bonuses. And the bonuses are attached to private equity performance of the plan. A lot of it, which is private equity performance, which again, I think it's very suspect since it doesn't have any standards. They tend to make up their own, they can basically, value their own assets and make up their own performance. So there is an incentive here that we've got in Ohio, not only for the private equity managers who get compensated when they do better, but the staff gets compensated when they do better. So there is a tension there going on there that's kind of that's a little different. That you've got all this, because that's taxpayer, the money, salaries of public officials directly tied to private equity performance that is basically made up.
Well, now you're getting into a big topic, which is performance reporting, and performance reporting that isn't standardized like it would be in a regulated environment. Hit that in some detail.
Again, there is no, there are the global standards for performance measurement, the CFA or GIP standards are out there for private equity and hedge funds, but all the public pension plans refuse to use it. They'll claim to be GIPS compliant for all of their other managers, their stock and bonds, and say, well, we're compliant on performance, but they'll just forget the private equity and hedge fund performance like it doesn't exist. Like we just take whatever the manager tells us. And the thing is, with private equity holdings, a lot of times they're private companies. There's not much information. Some of them are actually based out of the Cayman Islands. So you don't even know where the cash that you sent is at the time. It's maybe back in these companies, but everything is very non-transparent, opaque. The performance numbers are, you don't really know when they're real until the performance, is the plan completely plays out. So there's a lot of games played with performance. That was another finding in Chicago. I found a lot of these old private equity partnerships with negative balances in them, just sitting on the balance sheet, but not occurring in the regular reports. And again, that shows to me the fraudulent way that private equity can actually create appearance of good performance in some years, and then you have this negative balance out there of nothing. That they've got games they can play on the performance side. So everything about private equity performance points to lots of rosy scenarios, exaggerations, and plain out fraud. And the whole industry is kind of looks the other way at it because of the power of that industry.
Talking about the power of that industry, in another book, The Myth of Private Equity, the author, who used to be a private equity executive and is now a professor at Johns Hopkins, very, very good book. And he shows that in certain states, I think it might have been Maryland, private equity was able to have laws passed where they made it illegal to disclose the fees, which disclosing investment fees is just a standard.
Yeah. And that's everywhere. They really don't have to, they're not disclosing. The Maryland laws are just one of many. This is a nationwide phenomenon. Jeff Hook's right on target in his book and with that. But you got to remember these private equity, the original private equity guys, Mitt Romney, that everybody knows about, Bain Capital. But then the current governor of Massachusetts is a private equity guy.
Oh, there's a lot. If you go through the most powerful people in the U.S. today, involved in financial markets, so many of them are private equity. Fed Chair Jay Powell. You could just go down the list. Private equity is everywhere.
It is everywhere, and people, we've got 3 or 4 private equity governors. You had Gina Raimondo in Rhode Island, and Ted was going after. She's a private equity person. Rauner was in Illinois was a private equity guy.
Virginia.
And then the new Virginia governor is a former Carlisle private equity guy, and Jerome Powell was a Carlisle private equity guy. The
And
list
just to
goes.
be clear, all private equity is not equal. You know, like they do a lot of good work, and I don't think you and I are saying all private equity is bad. It's just that there are some issues that need to be
Well, there are
addressed.
4 mega private equity firms that I just think are just too big and out of control. And those are Blackstone, KKR, Carlyle, and Apollo. Apollo's founder's been involved with Jeffrey Epstein and all these guys and all kinds of things at CalPERS. So these big 4, kind of the 4 horsemen of the apocalypse, I call them, are the dominant ones that I think are overcharging fee. And I really think they're just totally out of control, and their power is out of control. My state senator, Mitch McConnell, his largest donor over the last 5 years has been Blackstone. His 3rd largest donor has been KKR. So these guys give lots of money to politicians everywhere. Those big 4 are so dominant that they control. And of course, I've been involved with lawsuits in Kentucky against Blackstone and KKR, and they basically think they're above the law, and they really are. And they were able to take laws. I had transparency laws passed in Kentucky. And then they went there, and the lobbyists, mostly Blackstone, had them removed. So any transparency laws that you accidentally can get out in the middle of daylight, a lot of times they'll get in the darkness. They'll actually get someone to pass one and get it eliminated. In these midnight sessions at these state legislatures, there'll be these deals passed at midnight. And the private equity guy's fingerprints all over them. So Maryland is this one of many. They have set themselves up as above the law. Hopefully, we've had this discussion that maybe the SEC chairman Gary Kinsler can rein them in a little bit, but it is out of control all over the country, and taxpayers are really paying the bill.
That's very interesting. Why don't you talk a little about some of the measures you think can be taken to improve the situation?
Well, I mean, I would put, if you put public pension plans under the same laws as corporate pension plans, ERISA, federal law, then you have a lot more remedies. The fiduciary, and then there's also the ability when regulators fall down that you can do litigation in federal court for these public pensions. So I think putting them under ERISA would be it's not an easy fix, because private equity hedge funds will oppose it till the day they die. They will put billions to fight it, but it would be a relatively, on the surface, simple way to fix it and save taxpayers billions of dollars. The secondary opinion is just going to be better regulation by the SEC. We've got some glimmer of hope for incremental better things going on there, and again, hopefully the Pennsylvania SEC and FBI investigations will get more into more of the depth of private equity, but we're really not sure how deep they will go. So we're hopeful that they're going to need some investigations in Ohio. Ohio had a very big pay-to-play investigation around nuclear power industry, and I think the same type of pay-to-play happened in Ohio with private equity as well. But will the SEC or FBI want to step up and take on the industry? You pay a price for even regulatory industry people when you take on these powerful people.
Yeah, now let's pull this thread a little bit, because you and I have had discussions about the difficulty the FBI is going to have to prove pay for play. I mean, essentially, on one hand, it's tough because they have to catch someone with money in hand, and these are probably some of the most sophisticated people around. But number two, I think there's an accounting angle that you can look at. In Chicago, I think there's reasonably good evidence to suggest they should at least take a look at potential skimming, which I know isn't your subject matter expertise. But I think there are a lot of areas where they could, an FBI subpoena and some interviewing of those involved would go a long way.
Yeah, no, I agree with you. And, again, the IRS could get involved. These things are tax exempt entities. The IRS has theoretically has jurisdiction in them as well. And could, look at some things there as well, with agents within their realm. But there's not the will there from the federal government to put them there. I think but just in Pennsylvania is unique because of the constant 4 or 5 year media attention that has gotten in the major newspapers there. I mean, not daily, but at least monthly for the last 3 or 4 years. That has kept that, given them the cover, the SEC and the FBI, to go into Pennsylvania. We're not seeing that in Chicago. None of the major newspapers have even covered my report on the Chicago police.
We got some coverage on CBS too.
Correct.
But let's pull this thread a little bit as well, because I think it's evident that media coverage is important. And in Pennsylvania, they get credentialed media coverage, and it leads to an FBI SEC investigation. So pull in that thread and talk about the coverage in Ohio and where like the coverage started with Matt Taibbi. You could argue. I think you've made that point before.
Yeah.
So go through that whole history and why it matters.
So the history, well, I guess that there actually was Forbes actually did some initial, Neil Weinberg at Forbes did some initial work in North Carolina, looking at that when it was Forbes was kind of a Republican-owned organization. He was going at the Democratic treasurer of North Carolina. So that was the interest. So they actually did some work there early on. There was some good work there. And Gretchen Morgensen, who was at New York Times, Wall Street Journal, did some work here and there. But Matt Taibbi did the first deep dive into the full corruption about, and that's probably 8, 9, 10 years ago now as well, and brought me and Ted Siddell about. We were both worked with him on that. He also Matt introduced us to David Sirota, who Matt really hasn't done any articles since then, but David Sirota has kind of taken over the mantle in I would call the alternative media space, which is a lot of the internet, but they do work with some of the English, the Guardian, Intercept, Daily Poster is his new publication, Jacobin, Newsweek, that will run these his alternative stories that have started to look at some of it, and even deep pay for play. Sirota did some good pay for play in New Mexico, in a couple states. In New Jersey, he found Chris Christie, actually the governor of Massachusetts. These guys, they found some areas where they caught a little bit of pay for play. These like Governors Association. This was not the dark money; it was the semi-dark money. So they were able to find. David Sirota's been able to find some little pieces of this pay for play type of money on the edges, and he did in Chicago in 2014 as well. Another younger reporter, has worked with David Sirota and now doing it is Matthew Cunningham Cook, who's doing some great work. There's a great piece in Massachusetts on pay for play there on the governor and private equity governor, Charlie Baker, who actually, he had a nonprofit for his charter schools, initiative. It was just a kind of a charity thing, and all the private equity people gave tons of money to that. And then they got business with the Massachusetts retirement system. So there's a lot of in that alternative media. They continue to check out some good, at least once a month, some good articles here and there. And then Ted Siddell has his own column in Forbes, which he has constantly been cranking out articles over the years. I had a column in Marketplace with Wall Street Journal where I cranked out maybe 20 or 30 articles, maybe 6 or 7 years ago as well. And they're all archived on my website at christobe.com. And then Ted Siddell has a treasure trove of articles that he has put out. But the mainstream media has just been totally ignoring this in general. Outside of the Philly Inquirer, it has been a dark, and then Neil Weinberg once in a while at Bloomberg, Gretchen Morgensen now at NBC Universal, once in a while will do something. But for the most part, mainstream media has totally ignored this issue. In Ohio, the alternative press the only of the major newspapers, none of them, only the Toledo Blade, which is like the fifth largest, actually even reported the existence of Ted Sedell's extensive examination of the Ohio teachers. The other media is so captive in Ohio that they pretty much, write what the retirement systems want them to write, in my opinion. And then, in Kentucky, I have one paper, my Lexington paper, will do something once in a while. And then my Louisville paper, the largest paper in the state, has never even acknowledged my book or any of the work I've done. Kept it completely.
I think the Louisville paper is a New York Times company paper, if I'm not mistaken.
It's Gannett.
Oh, Gannett. Okay.
And then the most of the Ohio papers are Gannett as well. So I don't know if it's a local decision or national decision for them. So many of the other newspapers, though, are owned by hedge funds and private equity funds themselves. So that has been a major
Chicago Tribune, for example.
For example, yes, and their own Chicago Sun-Times is actually owned by some unions, and that is a mixed bag.
That's SIEU, which is an interesting story because they spent $500,000 to defeat candidates who favored transparency in California. And I still shake my head. I don't understand how a union membership benefits from supporting Wall Street in covering up this situation.
Well, but SEIU is a mixed bag. The local SEIU backed the reform candidate against the national. And then we have a reform group, SEI group in North Carolina that hired Ted Sedell. So you get it even within the same union, but the national union has dominated. Their former president, Andy Stern, is very affiliated with the private equity industry. So you get mixed bags even within the same unions. You will have the differences here on what they like and what they think is important and what's a priority.
Okay, so you and I've had this conversation before. Can you specifically identify how a union member would benefit from their union supporting the Wall Street position on this?
Well, if I was in their position, that would be that these Wall Street guys give our super PACs enough money that we can support candidates that will support our wage and other initiatives within state governments. So that.
And that's your theory. There's no documentation. That's just a working theory you have. And once you apply that working theory, a lot of things start to fall into place. It makes sense because it makes no sense whatsoever. I cannot find a logical reason why they would do it unless you throw something like that in there.
Well, and again, when I'm looking for reasons, I always follow the money. But when Citizens United doesn't allow you to follow the money, then you basically, I have to come up with theories and assumptions because I'm assuming, and I've heard this indirectly through, things that there's no way to prove, but, a teachers union will say, well, their main source of money for candidates is their super PAC, and that's their main power, political power in the state. And the major funders for that are the private equity hedge fund. You just pay them a little. See, so if you're a union member, here's what you say. The little extra that we pay in fees to our Wall Street friends, then they give it back to us. We can do better with that than the incremental loss to us. Because remember, especially a state pension, it's not the workers get their pension, their set defined benefit no matter what. The fees,
and there's no way it can go bankrupt either.
Yeah, it doesn't affect them. It basically just screws over taxpayers. So you're basically your thing as a union member is that we on the positive side, we get more good than bad from this sleazy operation. The Republicans are dealing they're sleazy as well. Our opposition's sleazy as well. We have to play in the sleazy arms race of dark money. So we have to take we have to take the money. We're better off taking the money because really it's the taxpayer. It's not us it's taxpayers who pay anyhow. And that, in the end, we're better off politically having this money and looking the other way and having this money than, trying to be honest and transparent. Wow. That's kind of my working theory.
And well, it answers some questions. And once you have that as a working theory, you can start to piece together this story because it doesn't make sense. There are so
No,
many spots in this story where I just shake my head. I'm like, wow, there's frozen, I should say, investigations, there's frozen regulatory actions. So you look at this from a high level, and they have the ability to freeze investigations and regulatory actions. The media, generally speaking, is having a difficult time covering it, and journalists want to do the right thing. It's career risk if they
yeah,
do it
yeah.
just like a regulator or a DOJ or FBI. And then they can change the laws around their industry to make what at one point was illegal legal. So that's complete control of a democratic system.
Yeah, and again, that's what we have in this, private equity has that much control, and so that's why it's so difficult, or get some things around the edges, try to expose as much as possible, and just we're trying to limit the damage to taxpayers, really, when you get down to it.
So is there anything else you would like to discuss regarding sort of we took that high level history of this issue. Is there anything that we might not have discussed that you want to chime in on?
I'm trying to think about it. It's again, I think there's no such thing as bad investments. I mean, these things are, diversification. There's room for different types in here. But when you set up, when your whole system of transparency breaks down, the first breakdown on the state level was not having competitive bidding in the RFP process. When that transparency process started breaking down, allowing secret no bid contracts, that facilitated that, and Citizens United, the combination of that and Citizens United has facilitated this incredible system that this feeds on itself and costs taxpayers billions.
Okay, let me ask a couple of questions regarding individual situations I've had. I've interviewed a number of disabled Chicago police officers, and there are a bunch of questions and patterns that I've seen. But one of the common patterns that I've seen is these people are afraid of their pension fund and losing pension benefits if they speak out. And do you see that elsewhere, or is that just a Chicago phenomenon? Because it's
No,
common in Chicago.
it is. I would say Chicago's probably near the worst of this, but I don't think it's uncommon at all. I saw it in Kentucky where I was a trustee. I had a former agency head come to me who it took they have an agency that's almost 100% federal funded, and they weren't allowed to fund their pension anymore. So she had to dissolve the agency and come back up as another agency. And it made the pension look really bad when she did it. Of course, it kind of screwed over the other pensioners because you had someone leave the system. When you leave the system of a 11% funded plan, it leaves that liability has to be spread among the remaining people there. So you have the rats jumping ship. So when we saw that, we saw our retirement system retaliated and withheld this woman's 6-figure pension. She was executive director. And they held it up for maybe 2 years, and she had to go to court. And I think she finally got something. But they use her as an example to other people not to buck them. That is not. I don't think it's totally unusual. It may not be common, but it's out there. That retaliation is a real fear. I mean, it's something I dealt with as a board member as well. Any trustees who try to be reformed. We saw in California, they get hundreds of thousands spent to smear their name and in retaliation. We saw that out in a California pension trustee election. So it's out there everywhere. Private equity's got the money and they're willing to use it to keep this corrupt system in place.
You just reminded me of a question I had that we didn't discuss. Talk a little about your experience as a pension fund trustee and dealing with staff. For instance, did you ever have detailed discussions about why they're making the decisions they're making?
Well, staff really wouldn't want to talk to me because I knew too much. I asked too many questions, so we had to do most of it in open meetings. And I was always kind of getting run around. I was not allowed to see contracts as a trustee, private equity and hedge fund contracts, even though I approved them and signed off of them. I was not allowed to see them. I was not allowed to see derivative contracts that I know you're
The
involved
Wall
with.
Street banks. I'd love
Currency.
to get, I'd love to get some staff. If I could question some staff on their Wall Street derivatives exposure, I'd love that opportunity. But that's a
Yeah,
sidebar. I'm sorry, I interrupted.
yeah, that's a different one. But that was another issue that I know that you got expertise in. It was more it was currency futures, but it was a whole
And
thing.
it costs them millions of dollars.
Yeah, there's a chapter in my first book, my yellow book, that I probably need to send to you on that. So the staff did all their always tried to hide as much as they could from me. They would answer questions to a point, but again, when the rest of the board, I would actually ask questions to be put in the minutes, and then the other people would overrule and have that part of the minutes stripped out of the pension board meetings. It was that level of so, and I would actually come in and print what I was going to say as official statement to the board and to put into the minutes, and they wouldn't allow it in.
Wow.
That's the type
so crazy.
that's the type of control. I would ask the auditors question. I'd ask the auditors question on why these things go, and they would look to the staff, and the staff would tell them no, and they would just refuse to answer my questions at board meetings.
Now, having said that, I'm sure we've both run into and spoken with CIOs of pension funds who are very intelligent, very forthright, very honest and duty driven. I've spoken with some Texas pension fund managers who, so I mean, I'm sure we can all name them. I think we're not castigating blame across an entire industry. There are individuals that maybe need a hard look. And in Pennsylvania, you're starting to see that.
Well, I think though a lot of CIOs get trapped in this stuff. So they start out being, clean, they come in, but then they have legacy corruption that they are almost forced to help cover up. So what I found is that some guys came in, the CIOs in Kentucky, they came in, not corrupted on this, but the problem was they had all these legacy investments that they had to continue the cover up on. And because they didn't want to, they weren't allowed to expose what's going on. And then they were under continual pressure from the politicians to actually go see and meet with certain investors and certain, private equity hedge fund managers, all behind the scenes were in constant pressure to meet with them. So what happens if private equity is that the staff they'll pick from maybe 10 private equity managers, but those 10 are the ones who got access to them, and all 10 of them paid money to get access. So it wasn't pay to play is one of my other kind of theories on this. For a lot of these big funds, it's not pay to play, it's just pay to access. So you pay a certain amount in the thousands to these political people, and you get access into the funds. You become one of 5 of 1 or 2. So the staff can honestly say, well, I picked the best out of the 5 here, but they don't know that all 5 of them had paid the price of admission to get in their door. So that's the other kind of one of my other working theories on how a lot of staff gets co-opted into this without really even knowing it, that they have that these guys have paid the admission price to get in the door and to have these meetings. And a lot of times it's a favor of it's the access that they buy. It's not the direct pay for play once they get in. So a lot of it is played very subtly. These are the smartest people in the world playing these games, all in the gray areas. And a lot of the staff gets kind of co-opted. And then the staff are put on the other biggest secret out there is that all these private equity funds have advisory committees. And a lot of them fly these advisory people, staff to, Cayman Islands, offshore, different places. And these meetings are always off the books. There's no, they pay for it all. So there's no taxpayer money spent on some of it. So the staff gets to travel to these and get wined and dined by these people and programmed by being on these advisory committees. And what's really interesting, the only way I found out that the staff was on an advisory committee is one of the staff, who was the deputy chief investment officer, applied to be the chief investment officer. He put it on his resume, the 20 advisory committees that he belonged to. You will not find any listing of advisory committees anywhere. It's all very secretive because they use that as a tool to keep staff, and the staff, a lot of them after they leave think that the private equity guys are going to hire them and make them rich too. They think of the revolving door scenario that we see in so many other industries too. So there's all those factors playing all the time in this very murky world. And I've even tried in Pennsylvania to get, they can't even get to the fact of getting which members on which advisory committees. The Ohio guy, the chief investment officer, admitted that he tries to get on every advisory committee of every partnership. And that's like a couple hundred in Ohio. But there's no disclosure on who, where the meetings go to, who goes to the meetings, any of that type of thing. So there's just so much out there. This whole world has been created, whole shadow world has been created that keeps reinforcing on itself.
Well, let me clarify a point. You were clear that it's your working theory regarding pay to play, but there was an example in Kentucky, not in the pension fund where you were a trustee, but I think if I remember correctly, you told me about an example of pay for play in another Kentucky pension.
No, what happened?
They actually caught the guy and the FBI filed charges.
Well, what happened there is that most pension plans, there's also a health plan connected to it that invests. So for most pension plans, there's a retiree health plan connected to this. So I had I was working with the FBI when I became an SEC whistleblower, and they were following around a trustee of Kentucky pension plan, but he also was the director for the health plans for the state. And he sat on the board of KRS. So he sat on the board of the retiree health and the current employees health. So the FBI was following around, I believe, because I kind of told them that suspected him of pay for play. And they caught him taking bags of cash in the McDonald's parking lot. And
that's not how the Wall Street guys operate. Typically.
That's not how the Wall Street guys operate.
Much more sophisticated.
They're much more sophisticated. This was related to the health plan, buying off a consultant to the health plan, which is somewhat, but in the newspapers, they made sure it had nothing to do with the pension system or his role with even though the retiree health plan was under the pension, that they carved it out as completely separate, nothing to do with the pension whatsoever. And that he is clean as a whistle on the pension, and the pension actually is paying for his attorneys while he's in prison to defend him in these hedge fund lawsuits. They're paying for the pension, the taxpayers through the pension are paying for Mr. Longmire, who is serving federal time for this other crime, but he's completely innocent in the pension, so they're defending him. Hundreds of thousands of dollars they've given for attorney fees for him to defend him in the civil pension hedge fund cases.
Okay, so you're a whistleblower. Did a pension fund ever offer to pay your legal fees?
The pension fund, when we had the whistleblower, they said you are contingent to having. They said they chose a lawyer for everybody to have. They wanted a coordinated lawyer for all the board and all the things. Cover up. I said, well, I don't have the same interests as the rest of the board and the staff. I want my own attorney. So they said, they whistled and they figured, well, we have to give him his own attorney. So I got my own attorney, got it, Ted Siddell.
Okay.
And so Ted was paid. So they paid Ted his first bill of $25,000. Then he came out with a report which outlined all the corruption, and then they refused to pay him anymore. So even though they paid out over $3 or $4 million to defend it for him, they still have not paid him the $50,000 or so that they owe him at the retirement system, and they refused to ever pay it.
Wow, funny.
Yeah.
Good story.
Yeah.
All right. Is there anything else you'd like to add? I mean, we really covered a lot. I just have a feeling, I know there's some things we've missed.
Oh gosh, there's
I'll
just so
probably,
there's just so much that it continues. I mean, they continue. We see this. You look at the trade press like pension investments. Every week there are dozens of new private equity funds being bought by public pensions. Every week. It is just incredible the amount of. It's all about the alternatives. It's, no one makes money off of index funds, so it's all about these alternatives, which Ludo has found have been 600 basis points or in fees in these things. So that's just driving this entire industry, and it's out of control.
well, thank you so much for your time, Chris. And I think I can speak for other people who appreciate the efforts that you're giving here, because there is some risk, even in your position. You're relatively insulated, but
Yeah,
there's risk to everyone involved in this. There's risk.
yeah, and I appreciate you doing this and taking up the cause here, because we have too few people in the media who are covering this, and we really appreciate your work on this.
My pleasure.